All right. Let's see where we're at. Video coming through. I can hear myself talking. That's good. Got about 5 people on. All right, we'll give it just a couple minutes. Let folks get on here, and then we'll kick things off. All right, excellent. Need a drink ice water here before we go. All right, got about a dozen of you guys here. Let's kick her off, huh? All right, welcome to week 6 is what I want. Week 6 of the Rational Investor School for Trader Development. This week we are finally getting into the candy store. Got all them vegetables out of the way. Now it's time to learn the technical analysis that a bunch of you are here for. So we'll be tying all of this together, obviously. So don't expect this to be in a vacuum from the other stuff we've learned as far as risk management and all of that. We're discussing the whole thing. Let me look here. I think I have shared with you each of the 3 setups that we are going to be learning, technical setups that we're going to be learning before the end of level 1. So let me go to pinned items here. There's the 3-step setup, the bot. I think I shared the planting flower setup earlier. There it is, planting flowers. All right, so all 3 of those are shared. They're in the pinned items. I'll be referring to those a little bit, and we're not there yet, but we will be getting into examples in each of those setups of the tools that we're learning as we go through these next few weeks in level 1. Okay. So this week in particular, we're talking about Fibonacci retracements and extensions. It is very important that you understand the difference between the two and when each one is used. We won't be using Fibonacci extensions that much in level 1, but it is important that you understand what they are, and you can, of course, incorporate those into your setups. Just do so, as always, do so through incorporating it in your write-up on your setup, practicing that, and seeing how the paper trades come out, making sure that it works. I went through a process for a while of trying to rebuild the bot setup using Fibonacci extensions instead of the numbers that we use. We used non-Fibonacci extension levels in there, and it just didn't work as well. I mean, Brian has put together is a pretty spot on, right? And so I ended up not using it that way, but um, I've used extensions pretty, pardon the pun, pretty extensively in my trading and other setups. They're not, unfortunately, um, where I'm using those primarily is in pretty advanced material with advanced harmonics. You're not really going to learn that until level 3. But for now, just understand the difference between retracements and extensions and know that extensions are used for profit taking, not for trade entry, and that retracements are used for trade entries. Okay, we will talk about both of them, but just know that most of what you're going to be using, probably 80-90% of the time, you're going to be using retracements in your actual trading. Okay, so let's blow this up so you guys can see it a little better. Retracements. We'll talk about that first, and then we'll go over extensions. All right, so as usual, we're going to go through the slide decks, then we'll come back and we will do the quiz, and then we'll get into the Q&A sheet. Okay. And actually, one of the things I should have open here too is my trading view, because I'm going to want to be showing you how to put some of the stuff on your chart and giving you some examples. Okay. There we go. Oh, that was from office hours on Friday. So, okay. Retracements. Here we go. And actually, I'm gonna move this chat over to my other screen so that I can see that while I'm talking here. There we go. Hopefully you are still seeing the right screen. Yeah, it looks like you are. Okay. All right. So there are certain levels that we see in the market a lot. These are what we call Fibonacci levels, named for the mathematician uh, who derived these levels from some um, key occurrences in nature. Uh, we don't know really whether these Fibonacci's get respected so often because everybody expects them to be respected, and so they just do, or whether it's kind of an underlying mechanism of how our brains work or how the universe works. We don't really know the underlying reason, and it doesn't really matter for us as traders. What we do know is that these levels get oh, is my hair a little crazy today? Um, oh yeah, it gets a little wild sometimes. There's a reason I'm called the Wookiee. Um, what was I saying? Oh, so we don't really know why the fibs get respected as much as they do, but what we do know as traders is that they do, and so it is a fairly reliable mechanism for determining levels that we are likely to show reversals at. Um, there are kind of three key components for um, when retracements are relevant, right? Um, Retracements work best in ranging markets, right? Where we're looking for price to have moved in a certain direction and then retrace to a certain level. We will also be using them in trending markets to an extent. We'll talk about that when we get into the bot a little bit in just a little bit. Uh, we definitely use a level that we refer to as our first stop level, right? That's the 38.2 retracement level. Usually, if we're watching a trending market and we're looking to see whether it is transitioning into a ranging market, what we look for is a resolution of that first stop target. And I'll show you how that looks um, in practice when we get into the looking at trading views part of things. And then the other thing that we look for, and this is really critical, is reload zones, okay? And that's the retracement range between the 61.8 and 78.6 level, okay? Let me show you what I'm talking about here. Let's grab a different asset here really quick, just so I don't want you guys get lost in my um, in all my text I was throwing on the board. Let me look at a weekly on this. Yeah. Okay. So let's get rid of this particular one. And let's look at the one before it, this move here. Okay. So when we're looking at retracements, and these can cover any range of time, really, right? Like this is weekly. This is covering literal years of time, right? When we're talking about first stop, we're talking about this, and you'll notice, oh, let me do this. Okay, so Brian occasionally in his videos draws things from right to left instead of from left to right. And sometimes he draws them left to right. And so he has to reverse his fibs for that. That can be really confusing for students. Um, and so what I do is I always draw my fibs from left, so historical point in time, to right, closer to current time. Okay, so I'm just following the timeline. that way. I always draw from left to right, and that way I can have my fibs non-reversed and everything's fine. Um, for retracements, uh, what you're going to be looking for is that your one value is going to be going to correspond with the level you clicked on the left. So it doesn't matter whether you're talking bearish or bullish, right? It's technically a or should that retracement bull should look like this. Okay. Bullish means we moved from low to high, and we're looking at a retracement off of that move. Um, and bearish is the inverse, where we went from high down to low. If I can get there. Um, Now I have particular templates set up where I draw a green box for my bullish and a red box for my bearish, right? But the key thing you need to understand is what we're trying to determine is from a previous move, how much we're likely to take back before we move up again, right? What zone are we likely to get into before we move up again? So that's where we talk about the reload zone between 61.8 and 78.6, okay? And conversely, when we move down, we're looking for where we're going to reverse and move down again. And so again, we look between the 61.8 and the 78.6 level, okay? Um, if you guys do nothing else than only trade in reload zones in the direction the reload zone indicates, that alone will improve your win rate dramatically. Okay. It's difficult because oftentimes you're watching something going up and you're waiting for it to reverse so that it can come back into a reload zone, and you just got to sit on your hands, and the FOMO gets really real then. Okay. Um, the sweet spot refers to just the middle of that reload zone. Okay. We talked a little bit about institutional fingerprints. I know there were some questions in the Q&A sheet for that. We'll look at that and what we mean by institutional fingerprints. We'll talk about how TRI uses fibs for ranging markets. Okay. So retracement levels basically come down to um, levels that were determined through um, through some mathematical constants. It's pretty interesting, and you can get pretty woo-woo and out there um, when you start looking into all the things that where these Fibonacci retracements come in. When we get down to Planck length and like the smallest size of measurement in the universe and stuff like that, a lot of this comes down into golden ratio levels. The golden ratio is specifically the 1.618 extension. Um, and so a lot of these Fibonacci retracements just are prevalent throughout the math of the natural world. It's pretty wild. For us, of course, all we really care about is how does it behave in the market, right? Is this something we can use in the market? And it is. It's something that comes up pretty frequently. We see a lot of movements that take place at Fibonacci levels. It's pretty uncanny, actually. Um, all right, so when we look at, he's got an example here of a long trade, right? When we look at a market move, right? One of the things we want to establish is where our pivots are, and this is the part that's kind of more art than science, right? Um, Pivots, when you see them on a chart, you see them. Like you can see that we pivoted off here and started moving down. We pivoted here and started moving up, right? We can see these pivots occurring in the marketplace. Um, how do you define what constitutes a pivot? Well, we're going to learn some tools next week that'll help with that a little more, but for now, suffice it to say, we're just looking for the extreme highs and lows of trending moves, right? We're just trying to identify these trending moves. And that's where the IFP comes in after we've identified that. So the IFP is what we're trying to define is what are the ranges where the institutions put in the tops and bottoms. Oh, that was one of the questions that came up at one point. I think it's in the Q&A document. It might have just been in chat. Um, Great share, man. Uh, there's Joshua with some of the cool Fibonacci spiral stuff. Um, the the institutional footprint, okay, is the levels that where the institutional investors, and these are really the people that move the market. Okay, you have to understand the amount of capital required to change the direction, to put a stop in for on a market trend um, is is enormous, right? The only individuals is probably the wrong word. The only entities that can do affect that kind of change are these institutional traders, right? The Goldman Sachs's and the big hedge funds, right? And what we can do is we're looking at their footprint, okay? So let me show you what I've just done here. What we're looking at is when we see a low established, okay, we look at the candle that made that low plus the preceding candle. And that range in there between these two candles is the range where we say, okay, that's where we're going to meet a lot of support. If price tries to come down into there, it's going to get pushed away from there, okay? Conversely, now, does that mean it won't move beyond that? No, not necessarily, but we can't expect a lot of resistance at those levels, resistance or support, depending whether it's a high or low. Similarly, on the high end of this move, we can see the high here. Okay, expand this up a little bit so you guys can see it better. Okay, plus the preceding candle's low gives us a range where we are likely to see a lot of resistance to moving above it. We can see price came up to that level, no. Came up again, nope. Came up again, nope. And then push down. Now, eventually, in this market, this is the gold market, right? Eventually, we did break beyond that level. We can kind of see it here. We finally came back up, and we had enough that we've pushed above it. Now we're fighting it. We're fighting around this level, right? We're trying to figure out, do we going to continue moving up, or are we going to move down and establish a new market here, a new institutional footprint up here, right? We don't know. That's still being worked on. So that's what we're talking about with institutional fingerprint. I think for those of you who are watching Brian at higher speed, it gets a little confusing because it sounds like he's saying the candle that made the higher low. But what he's saying is the candle that made the high or low plus the preceding candle. Okay, and that gets a little confusing if you're watching his video on higher speed. So that's all we're saying when we say institutional fingerprint. We're saying that at the extreme ends of a trending move, you're going to see an area of resistance and an area of support. Okay, and those are established by the institutional traders. Hasn't the market already turned? What do you mean, JDC? Give me some more clarity. I'm happy to answer that question. You're talking about here, up here? Okay, holding my screen still. Look at July of this year, September. Okay, 2018. 2018. I'm looking at it. What about it? September 2018, right here. Yep. Sorry, I'm not trying to be a pain, JD. Are you talking about this structure right in here? Uh, maybe, right? Um, we can look overall, right, at this whole move. Is this another swing up? I'm not necessarily opposed to that idea, right? We've got a definite W in there. I kind of like that. Sure. I mean, keep in mind each of these little pivots that happen, like, right? We've got more than just one institutional fingerprint, right? We got an institutional fingerprint here. We've got one here. We look at them in aggregate, right? So we have like all these different levels. And there's a technique in level 2 where you basically take you track all of your pivot highs and lows in a big matrix of the whole market. The chart gets really messy, but it's kind of interesting where you can see clusters of those together, right? So, so yeah, yeah, no, what you're seeing isn't bad. I mean, I like that. I wouldn't be opposed to, um, like doing a fib off of. I don't know if I'd do it off of that point or this point here, right? I feel like that was more of the ultimate low there. So my fibs would probably come off of here, this lower point, just because that you can kind of see how that was the pivot there. Yep. There you go. Josh was showing us an example of a matrix that's done. All right. And that's heavy stuff. That's for next term, for level 2. But those matrices are pretty interesting. But as far as like looking at the pivots, yeah, I mean you could see these, right? Can you see also how if we came off of this lower level here and we look at where that pivot occurred, like it's right at the 61.8. It's that Mountain Man one, right? So that's pretty interesting. There's an argument for a bot here, which should probably go a little further. Um, there was a good 3-step setup that came in here. Well, this is out on weekly. I mean, keep in mind how large of a time frame this is. Oh, weird. That got a little wonky. Get up there, right? So, so that's what we're looking for with retracements. We look for a move up, and then we're looking for where's it going to move up again, right? Similarly here on this move, boom. If we can get a pullback into this area, then we've got a good trading location. Now, it doesn't say that it won't move up at higher levels than that. Um, in practice, what I do when I trade is, let's say I was looking at this for a potential trade and I'm following along. What I'll do is I've got a template set up for the bot as well. So the bot uses non-Fibonacci levels, 33%, 50%, 66%, okay? And it wants a retracement that is between 33% and 66%, right? And this is a trend following setup, not a reversal. So I'll mark that up there, and then I'll change this to my regular retracements, and then I can draw this area here. You'll notice these overlap a bit, okay? There, and that's a bull zone, okay? So what I'll do is I'll follow an asset that I'm watching. If it comes down into this box, then it's I start hunting for the rest of a bot setup. If it gets down in here, basically if it gets into the RLZ range, I kind of stop looking for a bot and I start looking for a 3-step setup. And that's the difference there is a bot. Let me show you this other tool as well. This is going to be handy for a lot of you guys. There's a thing in here called a trend-based fib extension, okay, and let you draw your first range here and then draw down to wherever your retracement is, and it will do a full like A, B, C, D off of that level, okay, 100% here. And so if it starts getting into here, then I start looking for a bot, and that's, you can see up at the top of the screen, that's where my target is, that 100% level. But once we break into this reload zone, I stop looking for a bot. Okay, boom. And instead, what I'm looking for is a three-step setup, and a three-step setup instead uses the 50% level of whatever this down move is as my ultimate price objective. Okay, so it's a much smaller range, um, but it once we dip down into this reload zone, it's more likely we're going to get into like a ranging setup than we're going to get into a setup where we're going to extend beyond this. Okay, JDC the bot is a setup. I've shared it in the chat here. If you go to the pinned messages. It's just a setup where we are, and the name comes from, it's a very detailed setup. So you're like trading very algorithmically, like you're following specific steps at each one. And Brian used to say, if I can trade like a robot, I'll just be able to print money, right? And so that's where the name bot comes from. But if you go into the pinned messages, I shared my bot setup that I use. Um, and that looks like this. Okay, we'll look for a move down into that first box that I drew. There's some momentum considerations that we use. We'll be learning those in the next few weeks. Um, and so that's the trend following version. And then the ranging setup is the one where we get into a reload zone and then we look for a move back to the 50% of that, whatever the down move was. Okay. Uh, Geronimo says, how did I choose that level? How did I choose this level here? Chose that because that's an obvious pivot. Now, at the time that it occurs, what I'll be doing. Let me come back in time here. Right. So it's not necessarily an obvious pivot at this point yet. We don't know whether it's going to go down or not, but I'll follow it. Um, and I'm looking for a few things after I get that pivot in to see whether what I'm seeing um, is another range, right? But this is the part where I say it's more art than science, right? Determining where the pivots are. There are some tools we're going to learn next week for identifying these pivots. Um, a thing we call fractals. Okay, and it's not just us. I mean, it's industry. It's an industry term. But for right now, just suffice it to say we're looking for looking back in time, seeing trends, drawing Fibonacci's off those, and then looking to see where the market's going to go. Okay. All right. Let's get back into it. Sorry, little tangent, but I think it's important. Oops. Reopen, close tab. There we go. All right. So, all right. So that was Brian's example here of a long um, RLZ reversal, right? And his example of what a institutional fingerprint looks like, right? The areas where the market has been a bottom or top has been put in by the institutional players in the market. Here's another one up here, right? Uh, we see that often the markets will stumble, right, at the 38.2 level, and we need to see that resolved before we really can start saying that that trend um, has perhaps changed to a range, right? So then we come down into this RLZ, and then we can see that it took off again. Now, did we have a setup here? Maybe, maybe not. We don't see any of the internals. We don't have the rest of the stuff. Bear in mind, we always want 3 reasons for a trade. And what we're learning here with retracements is just one reason. It's just giving us location. Okay. When we talk about the 3 reasons we have for a technical setup being location, momentum, and price structure, right? This is the location portion. price structure is the part we learned earlier with the M's and W's, and we're going to learn some more market structure reasons next week. And then we're going to get into momentum reasons. That's going to be the rest of this course. Um, and momentum's like RSI or MACD, things like that. Okay. All right. And then when you hear refer to the sweet spot, we're talking about this middle line. Okay. I don't know that I have it drawn on my fibs. I probably should, but come here. Here. 702. Where's that? There it is. Okay. So the sweet spot is that midpoint between the 61.8 and the 78.6. Okay. All right. And then he has a short example in here. Like we discussed before, for the most part, for those of you who are new to the markets, I want you to be focusing on long positions and not getting into shorts just because shorts inherently involve margin. And I'd like to see you get comfortable with the process before you start digging into margin and having to understand that part. Okay. But nonetheless, we have an example here. I think it is important to show you the example because I think it's important for you to understand that these things you're learning, it doesn't matter what direction you're headed, right? We still have institutional fingerprints. We still have a Fibonacci retracement. And again, I draw from left to right. The 1 is up here, the 0 is down here, and the retracements are in between. And so then we've got the RLZ between the 618 and the 786 levels. We see the price come up, it resolves above this 38.2. Just a little bit of stutter here. Then it came up, and then in the RLZ here, it went down. You'll see we had a couple of these, so this happens a lot, where we drew one fib range, then we had another move down, because in a ranging market, what we'll often see is progressively smaller trends back and forth. We moved down again, drew another RLZ. It came up here, hit that RLZ, and then moved on down. Oh, yeah, that's right. You can't see my cursor when I'm doing this. Yeah, there's not really a way for me to fix that, unfortunately. But if you look, let me describe it here. So when you look at like the 2005 November down to 2005, 2007 November to 2008 March, that's the overall big move. Then we drew a RLZ off of that. Price came up to that 38.2 of that first level, of that first fib. We had one red bar down, and then we moved on up. Moved down. This time the range was between June of 2000 and says 2008, June to July. We drew a RLZ off of that, and that was that lower RLZ box. Price moved on up into that, and then moved on down. Okay. All right. So that's it is important to know that, like I mentioned before, it's institutions, not retail investors, who put in the tops and bottoms of the market. Because of that, and because we're not institutional traders here, right? It is important that we understand that what we're doing is we're not trying to predict and get in on trades ahead of time. We're waiting for trades to establish. We're waiting for pivots to establish, for trades to set up, and then we get involved in the middle part of that move. We don't necessarily want to participate at the pivots, right? That's way too much risk for the reward. We want to participate after we've gotten a market structure and momentum reasons come in, preferably at an RLZ, and then we ride the middle part of that move down. Okay. Let's see. So incorporating reload zones into your trading plan can greatly improve your trade location. Absolutely, can greatly improve your win ratio. Um, and when coupled with IFPs, you can trade like the institutions trade. You can understand where they've put in their orders that are going to establish the tops and bottoms, and you can trade accordingly. Okay. Once you add momentum and volume studies, um, those pivots really jump out, right? You will be able to identify those pivots pretty well. Just right now, you don't have a lot of tools to do that, but we're going to be learning that in this course in the next few weeks. And examples here, these opportunities wouldn't have revealed themselves with just price analysis, right? We really need to see the other elements in the study. All right, so that's retracements. Okay. Now, most of the time, like I said, you're going to be using retracements. It's not to say you can't incorporate extensions into your setups, but when we're talking about trade entries, what we're talking about are retracements, not extensions. Now, on the other two things, once you're in a trade, you want to ride that trade as long as you can, like a surfer, right? You want to ride that wave as long as possible. Um, and so the way part of how we do that is by taking partial profits throughout the duration of a trade, of a trend, once we get in on it. And we can use extensions for that, for identifying areas where it's good to take profits. Okay. Now, our extensions aren't um, only used for this, but that's just all we're going to be using it for in level 1. Once you get to level 3, you're going to learn advanced harmonics. And when we get into advanced harmonics, then you're going to be looking at um, a whole nother class of location criteria that uses fib extensions in some very, very specific ways. Okay, but we're not ready for that yet. For now, extensions are just going to be used for profit taking. Okay. Now, extensions work best in trending markets because again, we're looking at having gotten in on a trend and we're looking at where do we take profits. Trends are defined by higher highs and higher lows or lower highs and lower lows, right? Um, Very often, price will park itself in what we call the parking garage, right? That's the distance between 168.1% and 200% extensions. But the other key levels we use is 113%, 127.2, and 144.5. Okay. Um, the one place where we will be using extensions fairly frequently is with the bot setup, which is an ABCD extension. Um, and what we mean by that is that um, when we're doing a fib, so we're doing, I'm sorry, when we're doing a uh, retracement, we are looking for price entry, and when we're doing extensions, what we're looking for is price targets, right? And so if we're looking at a bot, like I was drawing on here earlier, we'll look at our retracements first for our bot location, right? Oh, come on, get up there. There we go. And then we're going to look at our trip-based fib extension as a way of identifying, come on, where we would take profits on this trade, okay? So this is showing us a full ABCD extension. Now let me show you another way that we can draw this. If we come into a trend line, we just draw from here. If it'll let me grab the right point, come on, to here. What we can do is we can copy that. You can just Control C, Control V to paste it. All right, we end up with another one here. I think you can also duplicate in here. Yeah, if you hit clone, that will clone it alternately, okay? And then you can literally just drag this, place it over your newly established low, and that's another way of seeing that A, B, C, D, okay? JDC, I could do that. That's going to slow things down quite a bit if I'm pausing to do that. So I'm just going to try to describe it to you for now, okay? All right. Let's see what you got here, Geronimo. Where to start your ABCD? Um, Generally speaking, when we're looking at an ABCD, right? Um, this is one of those where do you identify pivots at? It's a more art than science thing, right? I like to have the full range defined, so that's going to be my AB, and so then I'm going to do my CD off of that, right? Um, you're asking, would you do it, say, off of this one? Hmm, maybe. I probably wouldn't. I think that's a little. Um, I don't think that's really a valid range a um, for a Fibonacci, right? If you went from here to here, I don't know that I would go with that, right? Let's look at what that would look like here. Let me move that. There we go. Does that work? Maybe, maybe. I prefer the full range, right? Um, there's not really absolutes in here. Um, I I would recommend having copy paste. I would recommend establishing a way that you do it. For me, I'm always going to try to take the full range, right, um, of the move, and I feel like this wasn't really a reset. I feel like this is all part of that full range. So yeah, and in general, guys, I'm going to be showing you on TradingView where you're going to be able to see the position of my cursor. So uh, don't get too caught up in it. Just try to follow along, okay, guys? Um, so So that that bot where we're doing the full A, B, C, D is the one time that we're really going to be using extensions a fair amount, right? Most of the time, what we're going to be looking for in our target is going to be based on the retracement of the last move, and I'll show you what that means in a little bit here. All right, so Brian gives you a long example here from a gold ETF from several years ago. That's not that. That's the wrong link. GLD. I think that's the wrong link. Oh, well, there's something we gotta fix. What we got in here? Let's see what this is. Oh, that's just the retracements one from the last slide deck, isn't it? All right, well, let me see if I can just blow this up so you can see it a little better. Okay. So gold. Yeah, we gotta fix that link in there. Uh, so you have these institutional footprints put in here. You can see that's pretty wide here. Um, when one of the things we talk about, and this came up in the Q&A document, is what the 200% extension, what its relationship with the head and shoulders is, and this is an example of that, right? So we've got this head and shoulders where we have shoulder, head, shoulder, right? And if we take that range and we do an extension off of it to the 200% level, that is a pretty common price objective. Again, I know you can't see my mouse, but that is a pretty common price objective for that head and shoulders. So we had the head, or we had a shoulder in December, a head around the end of the year, and then the other shoulder in February. And you can see the kind of scalloped lines there indicating them. All right. So, all right, there we go. Okay. So extensions are, um, like I said, there's something that gets used with ABCDs. It gets used with identifying targets off of like heads and shoulders. But in most of the setups that we use, like in the three-step setup, um, in I think almost every setup that's in the library, uh, we're either targeting our objective off of like a 2-to-1 risk to reward, or we are targeting it off of a retracement from a most recent move. Let me show you what that means. So in the case of a, let me find another asset that just to give us a little variety here. Okay, so, well, maybe I won't show you. This is going to be a bearish one, and I think that's going to. It's not a good one. Hang on. Try to find you guys a good one that is going to be bullish and will be. Oh, that's not a bad one. Where's our pivot here? Okay. So we're still on weeklies, right? Actually dip a little bit below the reload zone to set up on this one. But when we get this setup come in, right? I don't know if we have the internals for this because I only have what you guys have learned so far on here. But when we're doing this, when we're looking at targeting, get up here. Hang on. I like to have these a bit precise. That's just in my nature. Bearish. Okay. So what we look at is we saw this move up, right? We drew the reload zone here. That's this green box. We came down just a little bit below the reload zone. And then for a three-step setup, we look for momentum reasons, and then we look for price structure. Now we do have price structure here. I don't know if we have the momentum reasons to do this, but we'll get into that in the future. But in terms of momentum, we look here, here, and right here on this candle, we got a W put in, okay? And so we would look at pricing, and somebody asked me to go over the long and short position tool here, so I'm going to use the long position tool here. I usually put a bid in at the candle body open of the candle that confirmed the W. That's very, very common for me, okay? Then I have to risk down to the lowest point of that W. And then where we look to take profits is at the 50% level of this latest move. So the move before the latest was where we drew our RLZ off of. And then the latest move is what we're looking to do our profit taking objective. Okay. Let's come up here. And that would have gotten paid. It would have taken a while, but it would have gotten paid up here. Okay. Um, and that's a good example for you of how we use the retracements for our price objectives. Now, could you have done an extension off of this as well? Well, let's take a look. Usually when I'm doing an extension off of market structure, I'll draw from like a W from the first low to that middle point. Let's set this to TRI extensions, right? And we can see the 200% is here. I'm curious where the 4.618 is, right? So 4.618 would have taken us right up just above Mountain Man here into this reload zone. And that would have been valid, like we would have gotten paid, right? But if you're using extensions, what you're going to do is probably take partial profits at certain key levels. Like I'll usually take partial profits at 1.618, 2, and then just trail the rest up as high as I can go with it, right? Um, we've got a thing that there's a mathematician whose last name was Foggenbaum, and he discovered that in chaos mathematics, uh, which is the analysis of patterns forming out of randomness or chaos, right? Uh, he discovered that 4.669 was very often um, prevalent in these mathematics. And so I use this in my day trading incidentally. We got a number of people on the site that will use an extension of 4.669 as their ultimate target objective, right? And they'll take profits along the way, but that would be their ultimate objective. So hopefully that makes sense. Um, so that's the key part. These extension levels are profit-taking objectives. You're not going to use them a whole heck of a lot probably in level 1. It's pretty common. It's not until you get into level 2 and level 3 that you really start leveraging these, but it is important that you understand what the extensions are versus retracements. Okay. Um, all right. Here's a short example in here. Um, Brian's got a note in here that previous ranges often hint at future price objectives. It's true. Couple those extension targets with harmonic patterns like ABCDs, and you get a pretty powerful tool for price projections and for where you take profits. Would this be a good example? Let me look, Steve. Let me put this over here where you guys can see it. All right, so there's your fibs, head and shoulders forming right around the 38.2. Yeah, yeah, it's not bad. This is where you might use the extensions of that head and shoulders. Go from the head to the lowest neckline and see what a 200% extension looks like, but it looks like it's going to go down into the RLZ. So that's not terrible. I don't love that head and shoulders. I'm pretty finicky about my head and shoulders, and I really want a as close to level line as possible. I think that's probably a little more than my 10% that I allow myself on the angle, but that's me. I'm just very particular about it, and a lot of people that trade head and shoulders aren't as persnickety about the neck levels. So no, that looks pretty good. I like it. I will also give you the horns of glory. All right. Um, So that's pretty much it for fibs, right? So you're drawing preferably off of market structure or the full range, right? Usually I use market structure to guide kind of that first area, so an M or a W or a head and shoulders, and that'll project up extension levels, and I would just take profits as we go along, right? I might split that into say um, like 3 profit taking objectives, and I'll take a third of my profits at 144.5, or I'll take another third at 161.8, and then the remaining at 200%, right? That's pretty common. All right. So, yeah, so that's how we use extensions. Let's get into the quiz really quick. Retake. All right. So the Fibonacci retracement tool is best used during what type of market state? Right? The retracement tool we're going to use during a ranging market state because we've moved in one direction once, we move back, and we're looking at moving again in that direction. So ranging market state is best. As I did by example, though, I did show you that we also will use it in a trending market state for things like the bot setup, where we're looking for a pullback and then a continuation. All right. The first stop is a reference to which Fibonacci level? It's 38.2. Hey, Chooks. We have been going for about an hour. Which of the following is not a Fibonacci level? So, 38.2, 61.8, 78.6, and 88.6 are all Fibonacci levels. The 50% level is not a Fibonacci level. We actually get that the 50% level out of GAN studies, which we'll learn in level 2. And then the reload zone is bounded by which two Fibonacci levels? That's the 61.8 and the 78.6. Hang on, let me put this out at the same time I'm telling Chooks about it. Be aware that North America has its time change on November 1st. So I think that's going to be the next course, right? Calendar. Well, I guess I know because the 25th to, yeah. So next week will be starting at this time. Okay. So yeah, be aware. November 1st, we change our clocks. So next week's will be starting about this time. I think I have that right. Okay. The midpoint of the reload zone is called the sweet spot. That's halfway between the 61.8 and the 78.6. That's the 70.2 level. Okay. And then the line in the sand, you'll see us refer to this as the Litz, refers to which Fibonacci level? All right, we're talking about the 78.6. That's the upper boundary, or the outside boundary, I should say, of the RLZ. And then Mountain Man refers to which Fibonacci level? That's the 61.8. Right. And then extensions at this point should be primarily used as exit locations. Okay, and that's really important. Don't mix up your extensions and your retracements. And then our best trade locations develop when our best trade locations are often found when extensions project prices into RLZs, and that's where we are expecting to take profits on our trades, and then we end up in an RLZ, and that's a great place to set up the reverse trade. Okay. And again, we're setting it up because of the RLZ, not because of the extension. Extensions are about taking profits. RLZs are about entering new trades. All right. And then often this harmonic pattern lines up with extension levels. Okay. We're talking about the ABCD in this particular case. Okay. And then which of the following is not an extension that TRI teaches? Okay. We do teach 113. We teach 127, 161. We don't teach 157. Okay, it is actually a fib, but it's not one that we see respected too much. So, and why does TRI include the 144.5 extension level? Because it's the midpoint between the 127.2 and the 161.8. Okay. And then what extension level does TRI include that is not a Fibonacci number? And that's the 200% extension. Again, that's a Gann thing. And then what market and transition pattern does the 200% extension level correspond with? And that's the head and shoulders. And what term does TRI use to describe the 161% to 161.8% to 200%? We refer to that as the parking garage. Very often price will park there for quite a bit of time as it consolidates for its next move. And to know that you can handle yourself and manage your actions in the marketplace, who do you need to have a conversation with? Really? Yourself. You really need to have a conversation with yourself about um, your emotional reactions to things. You need to be there's no gain in lying to yourself, right? So, and then based on the course material, please select all the answers that represent TRI's, excuse me, valid reasons for a trade. Okay. So, market structure is going to represent a valid reason for a trade. Location. Yep. Um, indicator confirmation, ideally with divergence. Right. We haven't really gotten to overbought or oversold. Gotten a little into market state, but that itself isn't really going to be um, like a reason for a trade. That's just going to tell you what the state of the market is. Oh, you're 23, not 27. Hmm. Okay. Well, I'm giving you some extra stuff then. As long as there's no questions that you had that I'm not covering, that's okay. I've got to make sure I'm in the right version of the quiz. Sorry. All right. Based on the lecture, what does TRI like to call people that make money from trading? What do they call them? Institutions, whales, smart money, all of the above. And then Fibonacci levels can be used to determine critical points in a chart that cause an asset's price to reverse. The Fibonacci retracement tool can be used to identify possible areas of support and resistance. And then when using the Fibonacci retracement tool and drawing from a swing high to a swing low, what is the study attempting to demonstrate? Now, this was a difficult one because Brian draws his backwards, right? So, and this I think was part of the reason we changed things. What we're trying to identify is the amount of the rally that the market will likely take back. That was confusing to some people because if you're drawing from left to right and you're going from swing high to swing low, that wasn't a rally that you were looking at, right? And then what is the definition of an institutional fingerprint? That is the bar, where's that? Bar that made the high or the low plus the preceding bar. There it is. And then based on the class videos, if the market state is a bull, at what level will buyers step up and defend their positions? Um, so this is according to the class video, right? They're going to step up and defend their position at the 78.6 level, the line in the sand. And then true or false, institutions do not buy up markets. That is true. They buy down markets, they sell up markets. And then complete the following sentence. Buy when it what and sell when it what's. It's buy when it snows, sell when it goes. And then the Fibonacci extension tool is best used during which type of market? The extension tool is best used during a trending market state. And the Fibonacci extension level of 161.8 is known as what? And that is the golden ratio. All right, guys, you got some bonus questions apparently in that review, but there we go. All right, let's get into the Q&A sheet. All right, week 6. Hey, I should probably put the video link in here. Copy video URL so you can review it later. Boom. All right. The question is, can we apply ABCD harmonic patterns to any trending market? Is there any percentage limit on retracement? And for example, ABCD pattern if invalid if we retrace more than 66%. The ABCD can apply to any trending market. Okay, there's no absolute limit, but typically the retracement, if it retraces much beyond 61.8, like I was showing earlier, we tend to be looking at a price moving into a range. So in practice, what I do is I hunt trend following retracements using the bot setup, which caps at 66%. And if it goes beyond that, then I'm exclusively looking at the 3-step setup. And really, if it gets into that RLZ at all, I just start looking at the 3-step setup. I start looking at a ranging setup back to the 50% instead of an ABCD. All right, actually, let me take this out. All right. And then, can you show more examples of institutional fingerprints and explain how to find the IFP in the chart? I am still not clear on finding the AFP, or IFP. I'll also explain what the bar that made higher or low actually means. So this is one of those examples of when it's bad to listen to Brian at high speed. What he's saying is not the bar that made the high or low. He's saying the bar that made the high or low plus the preceding bar. And I think I walked through this enough, but let me know if it was unclear and if anybody needs me to get into IFP a little more. What setups can we trade based on fib extension levels? So we don't have any setups in our library that specifically use fib extensions, except the bot, though they get used heavily in advanced harmonics, which you'll learn in level 3. Instead, what we want you to be doing is understanding the difference between retracements and extensions and looking for ways you might want to incorporate extensions in your own setups or in modifications of the current setups. It's very common to take setups that we have in the library and modify them to make them your own. Okay, I've done that. That's why I shared my version of the bot, which has momentum indicators, but the bot as it's on the library does not have those. JDC, you said you could use a little repetition of IFP. Sure, absolutely. So all we're saying with IFP is when we find pivots, where's that? Remove drawings. When we see pivots in the market, okay, so when we get to the ultimate high or ultimate low of a trend, we want to define the range where the institutional traders have put in their orders that establish the top or bottom, okay? And so in this high, for example, we can say that this candle that made the ultimate high plus the preceding candle here, now that is encompassed by the range of this candle, so what I would do is just use the full range of this candle. That what we're seeing here, let me get it, is the IFP, okay? This is the range in which price is likely to be reversed if it comes back up into it, because the institutions have put in orders here saying this is as high as we want to go, okay, for right now. Similarly, if we come down to this low, we can look at the lowest low, okay, plus the previous candle, so that's up to here. And now this area defines that IFP range for the low that was put in here. Okay. Now each of these pivots has their own IFP, right? But obviously, the ones where we have the ultimate pivots are going to be the most powerful, and the higher the time frame the IFP, the more powerful it is. Taylor, she said, so the IFP can create a bull or a bear market. It's not that it creates it. The IFP shows us where that market was transitioned into a bull or a bear market. We see the IFP in retrospective. We don't see it ahead of time. The IFP is telling us here's where um, they have said no higher than this. Here's where they said no lower than this, right? And as each of these pivots comes in, we're going to see that again and again, right? No higher, no lower. And we see this consolidation happen. And eventually we'll see a breakthrough. We see it break through here. We will see it break through down here and then ultimately get rejected up to here, right? But these levels become key support and resistance levels. And you're going to build on that when you get into level 2, okay? And we really learn a lot about um, support and resistance. What did I mean by time frame? Yeah, I mean higher time frame weekly, lower time frame hourly, right? Um, for example, the higher time frame that when we see a pivot on a higher time frame, that pivot and those orders are more important than what we see on an hourly. They're stronger. Okay, there's more volume of orders that are pushing it in that direction. All right. Does that help, JDC? All right. Cool. Um, Here we go. The course material institutional fingerprint says the bar that made the higher low in the preceding bar. Again, it was high or low plus the preceding bar. Um, can we take a trade based on the ABCD pattern that is in line with fib retracement and extension levels? Sure, but you always need 3 reasons for a trade, right? Fibonacci retracements are just one reason. That's your location reason. Market structure, W or an M, for example, or descending triangle or whatever, is another reason. That's your market structure reason. But you still need a third. We'll be spending the next few weeks learning about the third category of reasons, our momentum reasons. Randall, I'll catch you later, man. Have a good one. Video will be here, so ask any questions you got in the Q&A sheet. Um, so it's important to know that, yes, the ABCD pattern um, can be in line with your targeting for your trade, but um, the retracements are just one part of that. And your ABCD part isn't really a reason for a trade, right? Your ABCD is just telling you where you're looking at a price objective, right? Um, and then where does the fib retracement start from? A retracement is showing us how much of a previous trend the market's likely to take back. So a fib's going to start at the beginning of that trend and terminate at the end of that trend, okay? Um, so you showed a couple of charts here. Here's this one, and here's this one, saying basically which retracement level is better, right? You see one of them drew it from here, and one drew it from here. I would have drawn it from the second one. I think this one's better. It captures more of that move, right? Because you can see this move. If you look at the other one, yeah, there's a little W here, but can you see how this is a big W here? Like this right here, this whole, oh God, you can't, how do I do this? Okay, let me do it this way. Um, yeah, let me pull it up. ADA BTC. ADA BTC. And it's a daily, I think. Maybe. Is that not a daily? ADA BTC on Binance. ADA BTC on Binance. Ah, that's better. Okay. All right. So you had drawn from here initially. Okay. And I can see how there's a W in here. But can you also see how if you drew from down here, how there's an even bigger W prevalent in here, right? Okay. So larger larger W here and encompasses more of the complete range. And so what I would have used is this larger range. Okay. This is basically what I said in here. I said the second chart is better. We really want to capture the full move. Okay. All right. On which time frames are IFPs manifest and significant in relation to fib level analysis? It appears the daily chart is clearly dominated. Oh wait. So Dravilla asks, so we really look for confirmed trend reversals for starting points on fib retracements. I like that. That's what I tend to do. I look for some market structure, um, trend reversal indication, right? Um, an argument can be made that you'd want to go even lower to the ultimate low of this, but I would be perfectly fine with this, and this is probably the one that I would go off of because of that market structure reversal. So, where was I? Okay. On which time frames are IFPs manifest and significant in relation to fib levels? It appears on daily charts, clearly dominated by the IFPs. I would presume also the higher time frames. What about lower time frames? So IFPs are relevant on all time frames. I use them on day trading, on a 5-minute chart, even a 1-minute chart. I use them on my long-term trades, on my daily and weekly charts. The larger the time frame, the stronger the signal, however. If we can, for instance, establish a IFP at a on a weekly chart or a daily chart, and then we're looking to trade on an hourly chart, if price gets up into there and we see um, reversal action where it's going to drive price in the same direction as that IFP established earlier, that can give us a good reason. It's not usually my main reason. Like I don't really use IFPs as a location, but I have an X factor determination in my trade setups. So as I go through each of the reasons for my trade, I'll look at location. And for me, for most of my trades, if I'm looking like on the 3-step setup, if my location is in the bottom half or lower of this RLZ, I will add a percentage of risk to my trade. So I start at 0%. If location is good, I would add 1%, so it'd be a 1% trade. If it's in the RLZ, but it's in the top half of the RLZ, then I don't add anything. I move on to the next criteria, so I'm still at a 0% trade. Then I would look at momentum, the momentum categories like RSI, MACD, that stuff. Um, there's a reason. There are reasons that are good or sufficient in there. If they're good, I add a percentage of risk. If they're sufficient, 0%. Um, I look for market structure. If market structure is good, and we'll talk about what that means in a little bit here next week when we look at candlestick patterns, um, then I'd add a percentage of risk there. So that can get me as much as 3% for location, momentum, and market structure. But then I have another category that is my X factor. Um, and one of the things I consider in there is, are we bouncing off an IFP? If we are, I will add another percentage of risk to my trade. Okay, so I'll use it that way, but it's not really by itself a reason for a trade. Shouldn't IFP show some market structure? Not necessarily. We like to see market structure when markets transition. That lets us frame a trade around that. But markets transition all the time without providing us any market structure. Okay. Market structure is what we need as traders to take advantage of a market reversal. But a market reversal can and does happen very often without any market structure in it. Yeah. Yeah, no, it's perfect. It's because, for example, we can see the W on the bottom. So you can see the W established here. but we didn't necessarily see it at the top here. And if we don't see that and we still want to look at the range, so like if we're getting down into here and I look at a price objective, then I'll draw the fibs off of here, right? And I'll make this bearish. And then I start looking, I'm hunting this 50% as my target objective. So then I'm just going off of that pivot, even though we didn't have real market structure there. And we kind of did have market structure here, you just haven't learned it yet. So next week we're going to learn about like an empire or a fractal, and we do have that, and that is market structure. Okay. So we're going to learn some more market structure next week, and we're going to see what this market structure is, this fractal. Um, but we will often see market reversals without any of the market structure patterns that we've learned so far. It's pretty common. We do prefer to get into trades where we can see the reversal with a W or an M. There's a reason we really like W's and M's versus uh, like a fractal like this, and like I said, we'll talk about that next week. Hold on, my throat's getting a little dry. Better. Okay. Um, all right. How are head and shoulders patterns formed at the 200% level? They're not. The 200% level is an extension. That's talking about when we get out of a trade, not when we get into a trade. The head and shoulders pattern isn't formed at 200%. What we're saying is that once a head and shoulders pattern forms, price typically moves to 200% extension of that pattern. Remember, extensions are not used for trade entries, but for trade exits. So the 200% extension isn't talking about when a trade sets up, but about how long it's likely to run. Good call. So Joshua, on the question earlier about look for confirmed trend reversals for starting points for fib retracements, he says, I personally like to use a weekly time frame chart to help me easily see the significant pivot points for the starting and ending points of the fib study. Yeah, yeah, absolutely. Looking at a higher time frame, it is pretty common in my trading to do something I refer to as anchor charting. Okay, anchor charting is when you look at a higher time frame for your location. So you're looking to draw your fibs on that higher time frame, and then you move to a lower time frame for the rest of the reasons for your trade. When you're looking for your momentum indicators and your market structure, and the rest of your setup. Okay, and that's a very common practice. I use that pretty much all the time, both on my day trading and in my longer term trading. How do I draw ABCD lines, especially where's the starting and ending point? Are they drawn like trend lines connecting of higher lows, for example? So ABCDs. ABCDs for a bullish ABCD, you're going to go from the low to the high. Okay, let me just draw it on here. Use a trend line. Go from the low to the high. Okay, so you're defining the whole range. And then you could duplicate that. You can do Control V. And you can just drag that over to your new low. Okay. So if we were looking at an ABCD pattern here, that's what we would do. Okay. There's another tool I showed it earlier that I love called the trend-based fib extension, where you can draw your first AB, and then you just move this down to where your next low point is, and it will automatically give you the CD. Now you might have to configure this a bit. I did long ago. I have several points in here, so I set mine up to the 0 and 1 as your boundary, right? Then I put 33% in here because for this ABCD range, 33%, if I get a trade in here, I'm getting a 2 to 1 risk to reward. 2 up, 1 down, okay? Um, I have a 25% level in here. because that's part of the bot. I use this largely for my bot setup. 25%, 50%, and 66% are all part of that bot profit-taking mechanism. So you can read up more on that in this document, which I linked into our chat. So there's a couple different ways you can do it there. Okay. What is dead cat bounce? I just linked you over to the Investopedia on it. Dead cat bounce just means a small retracement after a long trend, and it comes from the notion that even a dead cat will bounce if it falls far enough and fast enough. Kind of gross, but that's what it comes from. Okay, off-topic questions. Can you please review the long position tool? So I think I showed it. The key part about the long position tool or short position tool is where you click, that's going to be like where you want your entry to be. You can move that around with this middle left-hand dot. Your risk point, you move with this bottom left-hand dot. Right? Your profit-taking one, you move with this left-hand top dot. And how long it is, you move with this right-hand dot. Okay? Does that ADA look like a dead cat bounce? It doesn't look very uppy, does it? We're going to learn some more. When we get into internals, we'll learn some more things that'll give us indication of whether this is just going to continue down or whether we think it's going to pop back up. I wouldn't really call that Ming out. Well, actually, no. On a shorter version, I was looking at this big thing, and this isn't an M, this big old thing, but this here is for sure. Right? When we look at this, from here, up, down, up, down, that for sure is an M. Okay. This other larger structure, if we come from down here to here to here, is not an M because this point is higher. Okay. So, I'll take a look in a second. Let me get this last question out of the way. So, what's your portfolio allocation? Stocks, bonds, cash, crypto. So I only really use portfolio allocation when we're talking about like diversification in my long-term portfolio. I think this is what you're asking about. If you're asking about how much I allocated to crypto versus other stuff, I can talk about that later. But I think what you're asking here is kind of what's my efficient frontier, right? And I really only use that in my long-term retirement portfolio. And a majority of that portfolio, like 90% of that portfolio, is in my 401k, which has a very limited asset allocation. I have 70% of that in Vanguard's broad market ETF, that's the VTI. So that effectively is stocks across 11 sectors, right? It's pretty weighted towards technology, but it is what it is. And then I have 20% of that in their international market, the VXUS, so that's large cap foreign companies. Okay, and then I have 10% in their U.S. bond index, which is spread across both government and corporate U.S. corporate bonds. My 401k makes about 90% of my retirement portfolio. Ironically, it's also about 90% of my overall portfolio. The remaining 10% is my individual retirement account, and those I have a lot more control over, but I trade those actively on a swing time frame. So I use beta weighting rather than diversification to protect those, which means I hold an equal number of shorts versus longs relative to the S&P 500. So no matter which way the market goes, on average, those trades are going to balance each other out. I also hold portfolio insurance against my 401k in my non-retirement account. And as I talked about before, in my particular case, having talked with my CPA and all of that, if my insurance value goes to zero because the market kept going up, I write that off in taxes. If the market goes down and I have to utilize my portfolio insurance, I have a little bit of a hit that I have to take in terms of tax. Um, and uh, and yeah, that's where it's at. All right. Let's get back over this your ADA question. Amount hits a 61.8 in the last range. Maybe. Let's take a look. About here. This is gonna be. Yeah, I mean, we have to see what's gonna happen, right? I mean, this could reverse back up. We just don't really know. All we're looking at really here is price action and fibs, and there's a lot more that we need to figure out to about what's going on with this in terms of internals, right? I mean, to give you guys a teaser, what I would be looking at personally is ADA, BTC on Binance. I don't trade Binance. I trade Bittrex, but not Binance. But let's take a look. I'm gonna have to make this. I'm gonna have to hide a few things because it's gonna be too complicated, I think, for you guys. Oh, it looks like I already did. Good. Okay. So this is all things you're gonna learn in this course. Okay. Um, so if I'm looking at ADA BTC on Binance, um, why I'm Bittrex and not for Binance? Well, I've been trading on Bittrex for quite a while, and there are things I don't like about it and things I do like about it. Um, Binance, this goes back quite a ways and probably isn't relevant anymore. When Binance first started out as an exchange, and I started trading on it, they would only let me do trades in like whole increments, um, and it was a super pain in the butt. And I ended up with a lot of like leftover little bits of cryptocurrencies that I couldn't even really get off the exchange, and it just soured me on them for a long time. And so I never really came back to them because of that. I'm sure they don't do that anymore because it was so irritating, but it just kind of pushed me off of them, and so I've never really come back to them, to be honest. Also, crypto is a pretty small portion of my portfolio, so um, so I haven't been exploring it as heavily lately as I have in the past. So um, Bittrex, I have my own issues about. Bittrex loves to like delist coins kind of willy nilly, and that makes me a little nuts. But it is what it is. What I would like to trade on is neither of those. I would really like a good high volume decentralized exchange that I could keep my coins on my um, that I keep my coins on my own wallets instead of on their exchanges, um, and still be able to get filled and get out. Um, Uniswap's looking pretty good. Yeah. What about crypto.com? I don't know. Is there an exchange built around crypto.com? Can I chart on crypto.com? Can I put in conditional orders? Like these are the key things. I mean, if so, I'll take a look. I'm not familiar with it though. Yeah, it's early on, but that's what I ultimately want to do with my crypto is trade using my own wallets, Uh, I don't really care if it's specifically atomic swaps or something else, but I would like a mechanism by which I can put in a conditional trade, have that execute out of my wallet, and have the liquidity that I can get in and out. Yeah, as you say, Joshua, liquidity is key. That's really the hard part with the DeFis that I've seen is getting filled, particularly in a larger quantity. Getting filled is really difficult. Um, okay, just to summarize, the fibs use past location to predict future price action. Um, sort of. We use past moves to predict um, where moves are likely to occur. Um, we're not, as traders, we're not really in the business of predicting fully future price action. But when we get into a good location, that's where we start looking at the asset and seeing if we have other indications of movement. We're not interested in catching, for instance, like let's say we're looking at this. We're not interested in getting into a trade here, right? We want the bottom to be established and we want to get into a trade after that's been established, okay? Up here. And we want to ride that trade, as high as we can up to till it reverses. But we're not in the business of getting into trades before the bottoms and tops have been established. Okay, so it's predictive to an extent, like location tells us where we're going to be interested, but the really key part is being patient enough to see that, okay, we've got a good location, we've got some momentum indications that price is probably reversing, and then still waiting until price reverses before you get into the trade. Okay, that's where the profit comes in. That's where we lower our risk sufficiently that the reward to risk ratio makes sense. Okay, so that's really critical. Yes, in the short answer, we're using the fibs to use past movement to give us a good location where price is likely to reverse and come and replicate that uh, direction. Okay, not necessarily the length of the move, that'd be an ABCD, but it might just come up 50% of whatever the down move was. But we're predicting the location gives us an area to predict for reversal. Then we need to look for other indications. Um, that's where we'll get into momentum and divergence and that kind of thing. Um, and then we look for market structure. We're going to learn some more market structure next week. That's where we're looking at M's and W's. Next week, we're going to learn about fractals and inside bar reversals, outside bar reversals. We're going to learn a few other things that are candlestick specific. Um, and then only once all of those things are in place do we get into the trade. Okay. Well, so the first stop, um, I primarily use the first stop when it comes to very like large time frames. When I'm looking for what's the overall picture of the asset. Okay. Keep in mind that a lot of what I'm doing is what we call anchor charting. Okay. So I look at a large time frame. I might be looking at a weekly, but most of my trading takes place on a 4 hour, right? So I might look at a weekly to say, okay, well, where are we at? Okay. We've had this ADA, for example, right? We've had this big down move. This is bearish, right? Until we break back above this 38.2, until we resolve higher, which means closes higher above it, um, we can't really say that we're out of this bearish trend, right? And that's what we're using that 38.2 for, right? When we're looking at oil, right? We had this move up, right? Let's do this bullish. Hey Brian, how's it going, man? And we might have looked at this previous bearish move and said, okay, well, are we moving back down? Right? Well, we can't really say that we've rolled over and are heading down until we resolve below this 38.2 again, right? Well, on a weekly. So, uh, when this moved down, when did we know that it had moved up? Once we started closing above this 38.2, that's where we know, okay, well, that downwards trend has reversed. And that's what we call that the first stop. It's like the first point at which we go, okay, it looks like we're resolving in the other direction, right? Mm. And Kevin just posted the BCS questions. This would be a great one to ask Brian, right? Brian can talk at length about the first stop and how we utilize that. Absolutely. Does that help a little bit, Costa? And we're just about wrapped up here, Brian, so you're going to be able to hit your broiler chicken show um, relatively early in the day, such as it is. Any other questions you guys got? Throw them on out, guys. We've gone through the Q&A sheet. I think I've answered all the questions in here. If I missed anything that people asked, point it out or repost it. Okay. Here's that on the daily time frame, right? So we really need to see a resolution below this before we say, okay, yeah, we're heading back bearishly again on oil, right? Any more questions in here? I don't think so. Looks good. Can we go over some of the trades in the log to see how you work things out? Yeah, absolutely. Good idea, sir. Uh, Steve, do you have any in particular here that of yours that you'd like me to hit? Maybe this one on line 114. Let's take a look. Does this qualify for forming a head and shoulders with a 5-degree angle? Um, yeah, I don't like the angle as much. The W doesn't really bother me. This W that you're seeing here doesn't really bother me too much because um, we'll see that semi-regularly in a head and shoulders, right? Because we had to come up here, we had to come up in the middle, we got to come up here. That doesn't bother me as much. I don't love the angle, uh, particularly because we are also seeing now this is the part that does bother me a little bit. Look at these internals. Look at the RSI. Okay, so we have the lower highs here, but we're testing that right now, right? And we've established higher lows up in here, and that's a little more disconcerting than the other stuff. Now it could be we pop up here into oversold. I'm sorry, overbought, and then reverse down from there. But I wouldn't say it's disqualified. I don't think it's terrible, um, but it's not my favorite. I'll be honest. I have kind of a jaundiced eye towards most head and shoulders. Um, I just it's rare that we see a head and shoulders that I'm really comfortable with and like. Let's see. Got anything over in the crypto side? Steve, here we go. Oh, well, ADA. We were just looking at that. Oh, you had a BTC in there? Oh, I was looking at the wrong one. BTC. Yep. Okay. Come on. Let's take a look. All right. Well, all right. So let's talk about the questions you have in here. Do we use the buy order just above the neckline or at the close of the first candle above the neckline? So here's how I do my trade entries. Okay. Whatever the market structure is that I'm using for my trade, whatever candle closes that market structure, so confirms that market structure, I look to enter on the candle body opening of that candle, right? So in this case, this is BTC USD on Coinbase. Let me pull it up here. Come here. BTC USD, Coinbase. Okay. Yeah, we were looking at that guy. This is a daily. So it's not too far off. Is that this guy here? March 2020. Yeah. Okay. Head and shoulders. Head and shoulders. I don't remember what that's under. No, no, no. Is it here? Yeah. Okay. So inverted head and shoulders. I think you were looking here, 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 here. Okay. Oh, weird. I guess we gotta go over to here for it to like it. Okay. All right. So for this one, we confirmed the head and shoulders on this candle. So I'm a cheap ass, and where I will put my bid in and something like that is here. The candle body open of the candle that confirmed this. And I'll just put my bid in here and I'll wait, right? I'm going to have my, grab our long position tool, right? I got to set my risk down below this head. Typically we do a 200% extension, so we can even take our extension tool, right? We could go there, TRI extensions, 200% extension, and this is part of why I don't like heads and shoulders. To do a 200% extension, you're only getting a 1-to-1 risk to reward, right? Now, could we, instead of using this whole risk off of the W that's up in here? Sure, you could, right? There's nothing wrong with that. Then we've got a pretty high risk to reward ratio. That's not too bad. But we're not going to get filled on this trade that I would have set up until way over here. Let me, I got to get rid of this for us to see it, but we would have gotten filled here, right? So we would have put the order in on this next day, on the 28th of July, and we would have gotten filled on the 4th of September, right? And then we just followed up. So that's how I do my order entries. The candle body open of whatever candle confirms the structure. We had some other questions. Inverted head and shoulders and close above the neckline. Stop loss at the right shoulder. Sure, yeah, that works. Like I was saying, there's nothing wrong with that. Most of the time when we're looking at structure, we got to risk to the bottom of that structure, but that kind of makes sense, right? Profit at the head height. So, profit is what I would be looking at is the 200% extension of the overall head and shoulders pattern, right? Uh, okay, I saw it afterwards. I guess it wouldn't be a good idea to chase it. Yeah, don't chase. You saw how I put my bid in, right? I put my bid in lower than where it's at. I never chase. I don't like that at all. Psychologically, it puts you in a bad position. Oftentimes, it's going to affect your risk to reward. In this case, the risk to reward wouldn't necessarily be awful, but you're not putting yourself on a great foot. Now, what you can do, oftentimes when I miss a trade, right, that's like a reversal trade, something like this, what I can do is then look and see if a bot sets up, right? This went a little beyond the bot for me. Some people would be comfortable with it, and they might look at like an ABCD bot setup, right? So something like that. Now that's almost done, right? We're almost at the profit taking part for that one. But you might keep following it and see if it pulls back and gives you another bot setup to get in on a shorter term trade along that thing. If we know that we've got a larger pattern working, right? Oftentimes, I will then look for a trend following setup to occur within that move up. That's pretty common for me. Okay, so all right, I think that's all the questions on there. But yeah, overall, it's not terrible. Like the angle's not bad, right? I mean, it's relatively flat. It's pretty good head and shoulders. And like I just said, I'm pretty jaundiced about my head and shoulders patterns. I don't typically like them, but well, that's not bad. Let's look at the angle. I bet you it's not much. So we kind of got to go off of this guy. Well, I guess that's not where we go. We go from this guy to this guy. Yeah, that's 1%. That's not bad. Yeah, yeah, that's not bad at all. Yeah. So okay. So when we see something like this and we missed it because we see it late, that happens a lot, right? Then I'll look and see, okay, is there a trend continuation trade that I can take that'll take me up to there? Particularly if I can get like if this rolls back and gives me a bot setup and that bot takes me up to around the same target, that's fantastic. I love that. Okay. That helps, Steve? If there's any other particular entries you'd like me to take a look at, I'm happy to do so. Awesome. Fantastic. All right. I think I might wrap it up, guys. It's about 10 o'clock. There will be more times than not that we gotta go beyond beyond our 2 hours, because there's so many questions. Oh, line 101 on crypto. Sure, I'll take a look at that before I go. Crypto line 101. All right, let's take a look here. Absolutely. All right. I'm gonna replicate this on my chart so I can see my cursor and all that jazz. What is this? This is BTC USD on Bittrex on a 4-hour. BTC USD Bittrex on a 4-hour. All right, let's see what we got. Uh, 1, 0. So we've gone up. Looking at a reload zone down here. Oh, you're looking for a short RLZ. I'm not sure that I have a short RLZ in recent memory. So something to keep in mind when you're looking at RLZs, okay? You're looking at, if you're looking for a short RLZ, you're looking at a previous move down, okay? A previous time when we have moved down, and that's going to give you our, then we come back up, and that's where you have RLZ, and we'll move down again. If you're looking for a bullish RLZ, you're looking at a previous move up. So I'm not sure where you're getting your previous move down for your RLZ. Like, I got to go back quite a ways, like way back to like our ultimate thing, right? So on a daily chart, we can maybe do this guy, and we're well above that RLZ. Let's put that on the chart. All right, so we have this move here. So you're looking at short RLZ. So you've got it drawn in here in red, and that implies that that's the RLZ, but that's not where we're at right now, is it? Where was? Oh, but this is earlier in time. Um, when is this? This is October 19th, October 20th. Not the 26th is way over here. So is this you in here? I'm gonna spike up. Oh, this is a daily. That's part of my problem. Looks like you're looking at around here, which isn't so much the RLZ. Bear double top volume divergence. Well, we haven't really gotten into that yet. And that's not how we do divergence. So we don't do divergence off of the raw volume. We're looking for divergence off of the OBV, which we're going to learn in a little bit. RSI divergence, is that divergent? Let's see. Let's throw RSI onto here. I think you're getting a little ahead of things here. You got to be careful of that. What do we have? We've got higher highs. And there. Lower highs. So that is divergence. We do have RSI divergence here for sure. Um, fractals we're going to learn next week. We haven't learned fractals yet. We haven't gone into OBV yet. I think you're getting a little ahead of yourself, man. Slow down. Let's work on the stuff we've learned so far first. Okay? It's a good divergence spot there. I don't know that we have OBV divergence. We'll see that in a few weeks. But and be sure you understand how the RLZs are drawn, because you had a big red area in here that indicates to me that we're in an RLZ, but there is no RLZ up there, right? Being beyond the RLZ is not necessarily a bad thing, but I need to know that you understand what that RLZ looks like and how you draw it. Okay. On the inverted RLZ, where do you put the stop loss? The right shoulder? Yeah, probably. Um, uh, all things being equal, I'll try to put my I'll try to control my risk down to the lowest point of that head and shoulders, but you're never going to get a 2-to-1 risk reward on a head and shoulders um, unless it's a very large pattern, right? Otherwise, so right hand shoulder makes a lot of sense. Why can't I answer the question even if it's next week? This is because this is about the whole class, PMAT. If I start getting into OBV, which we're not going to touch for 3-4 weeks, and if I start launching into other materials from subsequent weeks, that's going to confuse a lot of people. Okay. You need to slow down. Okay. This rush to move ahead isn't going to help you. It's really not. That's part of why some people have to take the course multiple times. Okay. Because they tried to rush ahead on everything and they didn't really learn the process. I need people to really understand um, the RLZ concept first and foremost. I promise I'm not trying to. Uh, you're talking to me? We can absolutely chat offline. I promise I'm not trying to slow you down or make things difficult for you. I need you to learn these materials. All right, this is really important. Um, and trying to rush through it is not going to help everybody. If you want to push ahead, you absolutely can. More than happy to um, have you book like a tutorial and we can walk through stuff. But I'm not going to go over it for the whole class when we're getting way ahead of everybody because that's going to screw too many people up. Okay. Yeah. PM me. Let's chat about it. All right, guys. I'm gonna wrap up, and if you have questions that you want to talk with Brian about, put them in the BCS list. He'll get the broiler chicken show going here shortly. And in the meantime, have a great week. This next week we're going to be learning about candlestick patterns. That's going to give us some more market structure components that we can learn off of. Um, the fractals, pay close attention to the fractals as well. That's going to give us a good idea of where to draw our pivot highs and pivot lows from on our Fibonacci's. All right, guys. Have a great one. I will talk to y'all later. And bye for now.